Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good.
So, for generations, if you asked like an everyday American to picture hidden wealth, um, you know, serious generational billionaire wealth, they almost immediately go to the exact same movie trope.
Oh, yeah. It's practically burned into our cultural memory.
Right.
You picture, like, a snowy mountain in the Alps, some very discreet banker in a sharply tailored suit, and, a completely anonymous Swiss bank account.
Exactly. That is the ultimate image. I mean, Jason Bourne, James Bond, countless heist movies.
Yeah.
Switzerland has always been the undisputed king of cross-border wealth. It's like,
Right.
it's the place where the world's money goes to hide, or at least goes to feel incredibly safe from whatever chaos is happening back home.
Absolutely. The ultimate safe haven.
But according to a recent analysis from May 2026 by Boston Consulting Group, or BCG, along with a massive stack of official market data we've pulled for today's deep dive, there's been this seismic shift in the global financial landscape.
A huge shift, yeah.
Switzerland has just been dethroned.
It really is a remarkable milestone for global finance. I mean,
Yeah.
the fascinating part is that the new crown doesn't belong to the traditional Western heavyweights.
Right, like London or New York.
It belongs to Hong Kong.
Which is exactly what our mission is today. We are going to explore how Hong Kong pulled this off, what it actually means for the flow of global money, and most importantly for you listening, why investing in Hong Kong right now isn't some Wild West free-for-all.
Oh, not at all.
Right, it's a very highly regulated, high-stakes game. So let's unpack the baseline facts first. Just how big are the numbers we are actually talking about here?
Well, they are staggering. If we look at that BCG data, the cross-border wealth booked in Hong Kong jumped 10.7% in 2025 alone.
Wow. In just 1 year.
Just 1 year. And that growth spurt brought their total managed wealth to roughly $2.9 trillion.
Okay, wait, $2.9 trillion.
Yeah. Now, strictly speaking, that number is running neck and neck with Switzerland's $2.94 trillion.
Okay, so it's really close.
Very close. But the momentum, the speed of the inflows, and just this broader structural shift we're seeing, it has officially pushed Hong Kong into that #1 hub position for dynamic wealth management.
$2.9 trillion. For anyone trying to wrap their head around that, we are talking about roughly the entire economic output of a major G7 country.
Yeah, like France or the UK.
Right, just sitting in accounts, being managed in one single city. But here's where we need to do a little bit of myth busting, I think.
Oh, definitely.
Because whenever a financial trend gets this hot, the rumor mill just goes into absolute overdrive, and retail investors can really get burned.
That is unfortunately very true. The hype often outpaces the reality.
Yeah, because I was looking at some market chatter recently, and there was this wild rumor going around that a massive $400 billion had suddenly flooded into Hong Kong funds just last year.
I saw that too. People were talking about it like a financial tsunami.
Exactly. But looking at the official data from Hong Kong's financial secretary, Paul Chan, in early 2026, the real story is quite different, isn't it?
Precision is everything in economics. If we look at those official figures presented by the financial secretary for the first 11 months of 2025, the actual net inflow was indeed $386 billion.
Okay.
But, and this is a big, but that figure is 386 billion Hong Kong dollars.
And there is the classic currency mix-up.
Exactly. That's what sets the internet on fire. When you convert that 386 billion Hong Kong dollars, the math brings it out to about 49.5 billion US dollars.
Okay, so the rumors exaggerated the inflow by like 8 times.
Right.
But let's be honest, $49.5 billion of brand new money flowing in is still a massive tidal wave.
Oh, absolutely. It's huge.
It just changes the nature of the story from this like completely unhinged panic to a very methodical structural shift.
Methodical is the perfect word for it, because that $49.5 billion represents a fundamental difference in how these two financial hubs actually operate.
How so?
Well, Switzerland built its entire centuries-old reputation on being a sanctuary. It's a static environment where capital goes to be preserved across generations. Hong Kong is structurally entirely different.
I was trying to think of a good way to picture this for an everyday American investor listening.
Okay.
It's almost like Switzerland is this giant, impenetrable vault carved into the side of a mountain, right?
Yep.
Old money goes there to sleep. It sits there to be safe from taxes or war or domestic turmoil. But Hong Kong feels more like a bustling, high-speed toll booth on the busiest interstate in the world.
I like that.
It's not where money goes to sleep. It's where newly minted Asian wealth is actively moving, working, and being redirected globally.
That is an excellent analogy.
Mm.
Because, to truly grasp why Hong Kong is booming, you have to look at the sheer explosion of wealth across Asia over the last 2 decades.
Right, particularly in mainland China.
Precisely. Imagine you are a Chinese billionaire or a massive tech company based in Shenzhen. For the past decade, your wealth has likely been heavily concentrated in two very specific areas.
Domestic Chinese real estate or the domestic Chinese stock market.
Exactly. And as anyone who follows even the most basic investing rules knows, you never ever want all your eggs in one single basket.
No, of course not. If the domestic housing market takes a hit, your entire net worth is suddenly exposed.
Right. You need diversification. You want exposure to U.S. dollars, which is the world's reserve currency. You want to buy global stocks, international bonds, maybe invest in European private equity.
Sure.
And because of the world-class legal framework, the tax structure, and the banking infrastructure that already exists there, Hong Kong is the most natural, friction-free gateway for that Chinese wealth to step out into the wider world.
So to synthesize that, it's not just that Hong Kong suddenly built nicer banks.
No.
It's that the neighborhood right next door got incredibly rich, realized they were way overexposed to their own backyard, and desperately needed a driveway to access the global financial highway.
That is the core dynamic. Yeah, and we have to remember it's not just individual billionaires seeking diversification.
Oh, really?
No, the corporate side of this equation is arguably even more impactful. If we look at the data from the first quarter of 2026, Hong Kong became the #1 initial public offering, or IPO market globally.
Wow, #1 globally.
Yeah, in just 3 months, they raised over 110 billion Hong Kong dollars across 40 new stock listings.
Let me pause you right there because 110 billion in a single quarter just from IPOs feels totally counterintuitive to me.
Why is that?
Well, historically, if I'm a massive, highly successful international company and I want to go public to raise capital, the ultimate flex has always been ring the bell on Wall Street, right?
The New York Stock Exchange or the NASDAQ?
Exactly. That is where the deepest pockets and the biggest institutional investors on Earth are located. Why on earth are these massive Chinese companies settling for a regional hub instead of coming straight to New York?
Well, that is the million-dollar question. And the answer comes down entirely to geopolitics and regulatory friction.
Okay, unpack that for me.
Under the current Trump administration in the U.S., the regulatory environment for Chinese firms trying to list on Wall Street has become incredibly strict. Specifically, it involves auditing requirements.
Let's clarify that for the listener really quick. Because of the auditing rules, the U.S. basically demands to look deeply under the hood at a company's financial books to protect American investors, right?
Correct.
But the Chinese government often considers that granular corporate data to be matters of national security or state secrets.
That is the exact friction point. It creates an impossible catch-22 for these companies.
Whoa, I see.
If they comply with Wall Street's auditing demands, they break Chinese law regarding state secrets. But if they comply with Beijing, the U.S. government threatens to delist them from the NASDAQ. So Wall Street has simply become an unpredictable, hostile environment for them.
So the front door to New York is essentially heavily guarded or totally locked for them right now.
Exactly. Which leaves Hong Kong as the most realistic, viable international funding window. They can access global capital without triggering that geopolitical minefield.
Do we have a recent example of this?
Oh, yeah. A great example from the data in June 2026 is Dejin Heavy Industry. They're a major wind power equipment company.
Okay.
They just raised about $850 million by listing in Hong Kong. And what's vital to note is who bought in. They pulled in massive global investors, including the Sovereign Wealth Fund of Singapore and UBS Asset Management.
Wow, okay.
There are also incredibly strong rumors right now that Ant International is gearing up for a massive private funding round of around $1 billion, setting the stage for a potential Hong Kong listing down the road.
That is a massive pivot away from the U.S. But wait, if Hong Kong is mostly serving Chinese billionaires diversifying their wealth and Chinese companies doing IPOs because they can't go to New York,
Yeah.
doesn't that make Hong Kong a bit of a one-trick pony? Like, what happens to all the Western money? Have American and European investors just abandoned the city?
And this is where the plot thickens,
Oh,
because the data shows the exact opposite. Following a major market rally in late 2024, official reports highlighted that about 40% of the funds flowing into the Hong Kong market were actually originating from the U.S. and Europe.
wait, really? 40%? That
Yeah.
is a huge chunk of capital from the West.
It is substantial. And on top of that, we are seeing rapidly growing inflows from the Middle East.
Like sovereign wealth funds.
Exactly. Massive funds from places like Saudi Arabia and the UAE, plus capital from Southeast Asia. Global investors are making a very calculated choice here. They know that if they want exposure to Asia's incredible growth narrative, if they want a piece of the companies dominating battery manufacturing, AI, and consumer goods, Hong Kong is the toll booth they simply have to drive through.
Okay, let me make sure I'm following the narrative arc here. Hong Kong has officially dethroned Switzerland in momentum.
Right.
We have money pouring in from Chinese billionaires seeking global diversification. We have massive Chinese tech companies doing IPOs there because Wall Street is too politically risky.
Yes.
And we have Western and Middle Eastern investors eagerly throwing money into the mix to get a piece of the action. It sounds like an unstoppable gold rush.
On paper, it certainly looks like a perfect storm of growth.
But here is where we need to look closer, because I was looking at the market charts, and there is a glaring contradiction.
Okay, what did you see?
If everything is so fantastic, why did we see a sudden sharp drop in early June 2026? Major Hong Kong financial stocks giants like HSBC and AIA, the very institutions handling all this wealth, took a very noticeable hit.
They did, yes.
If Hong Kong is booming precisely because mainland Chinese money is flowing in, why are the banks handling that money suddenly dropping in value? What broke?
Well, what you've identified there is the central underlying risk of investing in Hong Kong right now.
Okay.
The boon is entirely real, but you have to pay attention to the authorities managing the flow. In early June 2026, China's regulators initiated a severe crackdown on illegal cross-border investments.
Wait, let's pause right there. For an American listener, the phrase illegal cross-border investment might sound incredibly confusing.
Fair enough.
Because in the U.S., we have an open system. If I want to take my 401k or my savings and buy British tech stocks or wire cash to buy a vacation house in Mexico, I just do it.
Right.
It's my money. Why on earth is it illegal for a Chinese citizen to move their own money out of China?
That is a fundamental distinction between the two economies.
Yeah.
As you said, the U.S. has an open capital account. Money can freely move in and out. China, however, operates with incredibly strict capital controls.
Okay, meaning what exactly?
Meaning the central government tightly dictates and manages exactly how much of their currency, the yuan, is allowed to leave the country's borders.
And why do they do that? How does a billionaire moving their own money to London or Hong Kong threaten Beijing?
It comes down to basic supply and demand mechanics and how that impacts a nation's currency.
Okay, I'm tracking.
When you move billions of dollars out of China, you can't just take yuan with you. Nobody in London wants yuan to buy a house.
Right, obviously. You have to convert it.
Exactly. You have to sell your yuan and buy US dollars or euros. Now, if thousands of wealthy individuals do that all at once, the global market gets flooded with yuan. The supply skyrockets, the demand drops, and the value of the currency drops like a rock.
Got it. And if the yuan crashes?
If the yuan crashes, everything China imports, like oil, food, and raw materials, suddenly becomes catastrophically expensive, which causes massive domestic inflation and economic instability.
Ah, I see. So to prevent a run on the bank, so to speak, they restrict the exits.
Exactly. Currently, as a Chinese citizen, you are only allowed to move a relatively small, strictly capped amount of money out of the country each year.
Like for vacations.
Yeah, typically just for personal use like travel or paying for a child's overseas college tuition.
But obviously, if you're a billionaire trying to diversify a massive fortune, that tiny annual allowance isn't going to cut it.
It doesn't even make a dent. So for years, wealthy individuals have engineered loopholes.
Like what?
They use shadowy underground banks, or they open offshore brokerage accounts through online platforms that technically aren't licensed to operate on the mainland.
I see. And the recent June 2026 crackdown was Beijing stepping in forcefully and saying, enough is enough.
Exactly. They said, we are closing these loopholes.
Do we know how much money actually got caught up in this crackdown?
Based on the analysis, there is an estimated $54 billion tied up in offshore broker accounts related to this gray area activity.
54 billion. That's wild.
Yeah. Now, to be completely clear, the regulators didn't just seize everyone's money or force them to liquidate their portfolios overnight.
Okay, good.
Existing accounts are relatively safe for now, but major online trading platforms like Futu and Tiger had to completely halt opening any new mainland accounts.
Wow.
And they had to stop new money from flowing in right around mid-June.
Okay, so let me try a different analogy here to replace the toll booth, because this feels more mechanical.
Let's hear it.
Think of Hong Kong's financial market less like a nightclub with a bouncer and more like a massive, incredibly powerful hydroelectric dam.
Okay, I like where this is going.
For years, water meaning wealth was leaking out through tiny illegal cracks and side channels in the dam. The June 2026 crackdown was basically Beijing sending engineers in to seal those cracks with solid concrete.
Yes.
But, and tell me if this tracks, they aren't trying to stop the flow of water entirely, right? They just want all the water to flow exclusively through their official government-metered turbines
Exactly.
so they can generate power and track every single drop.
That is a brilliant way to conceptualize it. They want total control over the flow, not to stop the river.
Right.
And this brings us to a crucial concept for investors, which we can call the legal premium.
The legal premium. Okay.
The Chinese government has zero interest in destroying Hong Kong's financial sector. They actually desperately need it to function. Hong Kong's financial secretary, Paul Chan, explicitly emphasized that legal, transparent inflows of capital are highly encouraged.
So what does this official metered turbine actually look like for an investor? How do you move money legally?
The official channels take the form of state-approved, highly structured programs. The most prominent ones are Stock Connect and Wealth Management Connect.
I've seen those terms in the research. Let's break those down. What exactly is Stock Connect and how does it solve Beijing's problem?
Simply put, Stock Connect is a heavily monitored financial pipeline that physically links the stock exchanges in mainland China, like Shanghai and Shenzhen,
Yeah.
directly with the Hong Kong Stock Exchange. It allows investors on the mainland to buy pre-approved stocks in Hong Kong and vice versa. But the genius of it, from Beijing's perspective, is that it operates as a closed-loop system.
What does a closed loop mean in this context? If I buy a stock in Hong Kong, hasn't my money left the country?
Not permanently.
Yeah.
The plumbing is entirely fenced in.
Fenced in.
Yeah. When a mainland investor buys a Hong Kong stock through this pipeline, their money crosses the border to hold that asset. But when they eventually sell that stock to take their profits,
Yeah.
the cash does not go into a Hong Kong bank account where they can quietly wire it to Switzerland or buy a yacht. The system automatically routes the funds directly back into their original mainland Chinese bank account in yuan.
Oh, wow. The money takes a field trip, but it always has to get back on the bus and go home.
That's exactly it.
That is incredibly clever engineering. The government knows exactly who is buying what, the capital never permanently escapes the system, and it doesn't create downward pressure on their currency.
Exactly. And Wealth Management Connect does the exact same thing for investment funds and banking products.
Fascinating.
So if we connect this to the broader picture for the market, the future winners in Hong Kong's financial sector are absolutely not going to be the sketchy gray market platforms that help billionaires sneak their money out.
No, clearly not.
The ultimate winners are going to be the massive, heavily compliant institutions, the huge banks, the established insurance companies, the official exchanges that master the plumbing of these legal state-approved pipelines.
So, synthesizing all of this, what does it mean for the everyday American investor listening right now?
Good question.
If someone is looking at their 401k or their personal portfolio and thinking about how to get exposure to these different global financial hubs, how should they categorize them? Because clearly, Hong Kong, Singapore, and Switzerland are playing entirely different games at this point.
They serve completely different strategic purposes in a portfolio. I like to break it down into 3 distinct player profiles.
Okay, lay it out for me.
First, you have Hong Kong. Hong Kong is the growth player. It is inherently high risk, high reward, and it is inextricably tied to the fate of China's economy.
Right.
If you invest in Hong Kong, you are making a direct bet on Asian tech, Chinese domestic consumption, and the continued expansion of those legal financial pipelines we just discussed.
High beta, as the finance folks say.
Yeah.
A roller coaster ride tied to Beijing.
Okay, what about Singapore? We mentioned them earlier.
Singapore is the balanced player. If Hong Kong is the gateway specifically to China, Singapore has positioned itself as the gateway to the broader Asian continent.
Gotcha.
It is highly diversified. They have massive amounts of money coming in from India, from Middle Eastern wealth funds, and from wealthy family offices in Indonesia and Malaysia.
So it's broader.
Exactly. It's the hub where you put your money if you want to capture general Asian economic growth. But you are a bit too nervous about Chinese regulatory crackdowns.
That makes total sense. And that leaves our old friend, the former king, Switzerland.
Switzerland remains the defensive player. It is still the ultimate safe haven asset. So it hasn't lost its core identity.
Not at all. When global inflation spikes unexpectedly, when regional wars break out, when geopolitics between superpowers get incredibly scary. Capital still instinctively flees to the Alps.
Right.
It might not be the #1 hub for sheer volume and dynamic growth anymore, but it is undeniably still the #1 hub for security.
So, bringing this all together, here is the core takeaway I'm getting from all this data. And this feels like a really crucial paradigm shift for our American listeners to grasp.
What's that?
Investing in Hong Kong right now is not a way to escape China risk.
Yeah.
I think a lot of retail investors assume that because Hong Kong has its own currency pegged to the dollar and its own legal system, it acts as a safe harbor away from Beijing's influence.
Yeah, that's a very common thought.
But based on everything we've discussed today, that assumption is entirely wrong, isn't it?
It is a dangerous misconception. Investing in Hong Kong is absolutely not escaping China risk.
Yeah.
Rather, it is the designated marketplace where you trade China risk legally.
Well said.
When you buy into the Hong Kong market, you are essentially making a macroeconomic bet. You are betting that China's broader economy will eventually recover, that their tech sector will continue to innovate despite U.S. restrictions,
Right.
and most importantly, that the regulators in Beijing will continue to slowly, carefully expand those closed-loop legal channels for money to move.
It's essentially a proxy bet. You're buying a ticket to ride the Chinese economic engine, but you're buying it at a legally approved, heavily monitored ticket booth located in Hong Kong.
That's exactly right. And because that ticket booth is so heavily monitored, any news that comes out of Beijing, a new tech regulation, an easing of a real estate policy, or a crackdown on underground brokers, will send immediate shockwaves directly into Hong Kong's stock indices.
Which is exactly why those financial stocks dropped so sharply in June. The market was instantly pricing in the reality that the regulators are firmly, undeniably in charge of the plumbing.
Absolutely.
You know, it is truly fascinating to see how a single city can continually reinvent itself.
It really is.
Going from a British colony to a gateway for cheap global manufacturing, and now transforming into this highly sophisticated, totally unique financial valve for the world's second largest economy.
And managing to execute that transformation while navigating some of the most complex, high-stakes geopolitical tensions of our lifetime.
Which brings me to a final provocative thought I want to leave you, our listener, with today.
Right.
We talked extensively about how Wall Street has essentially put up a closed sign for a lot of major Chinese companies due to the Trump administration's auditing policies,
Right.
effectively pushing that massive capital demand into Hong Kong. We also talked about Middle Eastern sovereign wealth funds and European investors happily following them there to get access to that growth.
Yep.
So if Hong Kong actively continues to cement itself as the dominant, undisputed global gateway for the East, while Wall Street remains highly restricted and closed off due to all this geopolitical friction, could we eventually see the creation of two completely separate parallel financial systems in the world?
Whoa, wow.
One ecosystem centered in New York, trading in dollars for the West, and an entirely separate ecosystem centered in Hong Kong, trading in yuan or local currencies for the East and the global South.
It's a profound, paradigm-shifting question that every global economist is currently debating.
And if that bifurcation actually happens, if half the world suddenly doesn't need to use US dollars to trade, invest, and grow anymore, how will that fundamental shift in global demand change the underlying value of the American dollars sitting quietly in your own retirement account right now? Something to mull over. Don't forget to subscribe and hit that like button.